Cool, guys. Hi, good morning. So we are on chapter 16, looking at groups. So groups of companies, and really looking. This chapter is very much about planning and how we can, if you like, best utilize these losses that have been made within a group. Again, in class, I discussed this idea of groups fundamentally as departments, really. So think of a head office or parent company, and within that parent company, yes, has bought or controls these other businesses, and in effect, these become like some kind of functional organizational structure where these are now departments. So this is really one whole organization. So we can think of tax, if you like, as acting within one whole organization and not really worry about what's happening individually. So these companies can then technically share gains and losses, and we will look at what happens with capital gains when this with regards actual passing assets between departments, and actual trading losses. So what are the rules? There are some clear rules, and the issue really is a matter of control. I mean, when we come to corporate reporting, we'll see what control really means. But for tax purposes, the fundamental rule is that we really must have we really discussed it. We're in the realms of the 75. You must have a 75% interest. The parent must have, in fact, I'll go as far as saying the parent, just jumping to the key point, the parent must have a 75% effective interest in a subsidiary. Whether it's a subsidiary or a sub-subsidiary, there must be 75% effective interest for it to be part of that particular group with the parent. You can have another group, and we'll see a question, within the sub-subsidiaries where there is a 75%, but where you don't have an effective 75% with the parent, so they can form a separate group. Right, so let's see how, this is the key point here. Group relief is available to members of 75% loss group. So you can, as long as you're part of that 75% loss group, you can pass losses and offset with each other. So you can have something like this, like A has 100% of B and also has 100% of C. So they're all part of the same loss group, in effect. That's what we're really saying here. But you could have something that looks like this: A, B, and then C. So the question is, what is the relationship in A and C? And the effective relationship has to be 75% at least for all of them to be part of the same group, so for them to pass losses and between each other. Now, we'll come to it, but you can have companies that are international. So you can have, say, a non-resident UK company that's incorporated abroad, and that could be B, but B could connect A and C, so A and C could relate, but B cannot, if you like, issue its own losses or profits against any of the other members. So this definition of ownership really depends very much on ownership of share capital, the right to distribute profits, and the winding up. So it really does kind of focus or look at this notion of control. Right, so sub-subsidiaries, again, I have to highlight this issue of effective interest, and I highlight again this issue of being resident overseas. The groups can be created for companies, but you cannot claim or surrender your taxes through them. Right, let's see. So what am I saying here? So look at this example here. Neptune and Earth, this is less than 75. So Earth cannot be members, cannot utilize this opportunity to offset its losses or kind of use its own profits, or the other group cannot use its losses against Earth's profits. None of that can happen because there's a less than 75% interest. Neptune, you can see, clearly has an interest greater than 75%. The question then becomes, what about Venus and Jupiter? Can they be members of this group? And we can see clearly that Saturn, Neptune, and Jupiter can be members because there is a 90% effective interest between Neptune and Jupiter. But between Neptune and Venus, we can see that there is a 72% interest. So Neptune and Venus cannot be members of the same group, but Mercury and Venus can be members of that group, so they can relate, but Venus can. None of Venus's whatever profits or losses can be basically utilized by this group. Right. Okay, great. And this question says here, so we have the groups we have here, therefore, are Neptune, Saturn, Jupiter, and Mercury. That's one group. Then you have Mercury and Venus, which is another group, and then Earth just doesn't get into the picture. If Saturn was international, an overseas company, what you would just literally have is you would have these three part of the group. They can share, but nothing can be worked out with Saturn. Okay, great. So that's that. I think in class I highlighted that here. I asked you to write the word flexibility. Here you have the power. The person with the loss, the person with the losses. I mean, losses are valuable. I mean, people pay for them within groups. So groups will always pay a bit of a fee for a loss, to buy a loss, if you like. I mean, this is really a big issue, isn't it, in tax evasion, where people are opening up dud companies that are making losses to offset against their other companies that are making money, just because losses are that valuable. So there is a flexibility with losses, the surrendering companies. Company paying the loss. So here we are, surrendering companies, the company that surrenders its loss, and the company that claims it, if you like, is known as so this is the claimant company, is the company with the profit. So the restrictions really lie with the claimant company, and we'll look at that in the little rules. So what can you surrender? So yes, you can surrender your trading losses in your current period, as well as, if you like, brought forward trading losses. So now the issue here, of course, is that, of course, what you must first do is that you bring forward these trading losses and then you use them against other income, because there's no trading income. So you use that first, and then whatever's left, if you like, can be given. Whatever's left can be given to the claimant company. So, and we'll see an example, but the key point is you can bring forward those losses. And you can also relieve or give off any unrelieved property losses. So remember, we said if this is an automatic event where property losses are used against other income, if you like, in the year. So you have to do that first, and whatever is unrelieved is what we can then give off to the claimant company. And I think it's important when they're doing questions and we see this. And then, of course, any unrelieved qualifying charitable donations. But you'll see how this kind of works. Because of this flexibility, you can manage the situation to ensure you preserve, like any qualifying charitable donations, in effect. Right. So we deal with capital losses separately. QCDs and property losses are unrelieved if they exceed other income and gains before the deduction of any losses. So we'll see an example of how this actually works. But let's just look at this question of how property losses are if they exceed. So let's actually look at this example here when we're dealing with property losses. So what I was saying earlier on here is that you have property losses of 60,000. This is automatic anyway. What you cannot do is to preserve this 50,000 and then transfer this. No. You have to offset this first against the 50,000, and whatever is left, that 10,000, if you like, can be offset against, if you like, towards the claimant company. So there is, when I say flexibility, you have this. This is automatic. This, you always had to do this anyway. Remember when we did company, dealing with company losses, when we dealt with property and chargeable gains. If you have a property loss, you have to use it in your year. And then you can carry it forward and use against total profits and restrict it so that you can preserve QCDs in the future. So yes, we have to do this in our year. Right, the claimant company, this is where the drama begins. This is where the restrictions are. Restrictions are here. Right? So the claimant company they're the ones with the profits, and they're the ones trying to buy this loss or trying to make use of this available loss. The question is, how much is HMRC wanting them to work with? So imagine you have made profits in this year and you have losses from the previous year. Now, of course, in a perfect world scenario, you would love to preserve those losses and then use them, carry them forwards, or take someone else's losses. HMRC are like, no. What you have to do, well, I'll come back to this in a second. What you have to do is the maximum loss which you can claim is you've got your profits, bring your losses brought forward, full amount, whack those through. Here we are. So current, whether or not you claim the relief, we assume you do. Work that through and also deduct any QCD. So literally, they're making sure you use up all your losses first before you start claiming anybody else's losses, and that's kind of what the scenario is. And let's sort of see an example. I guess this is the thing with these things, you could talk about all day. Best to do an example. So let's look here. We have Zither. So Zither is the claimant company. They have the profits. We can see there very clearly. And Xylophone is a surrendering company, claimant company. So Zither has trading profits of 90,000, and so you have here 90,000, and they have other income of 7,000, 6,000, so that's 13,000. So of course that trading loss brought forward, of course you would love to be able to claim basically 113, wouldn't you, if you could, from the other party. And then, or in effect, you would probably love to sort of say, well, okay, I'll do 7,000. Perfect world, take the 13,000, knock out the 10, you have 3. This is not how it works, by the way. Then you have 3, then you have 93, basically, in effect, right? Preserve these because you can use this against total profits in the future and preserve. But no, HMRC like, no, here we are. Get all your income, knock out, use as much of your previous brought forward trading loss, and take out your QCDs as well, if you like, utilize those, and whatever's left is what you can claim, if you like. So they're minimizing the amount you can actually claim, minimizing what you can claim. Xylophone, this is a maximum they can give. They don't have to give all of it, remember, but they can. So what am I saying here? So they have 66,000 in this year. They have 16,000 brought forward from the previous year. So that's fine. Use this 16,000, clear out what you have from the previous year. There is no QCD in this regard. 16,000. So you have here 12,500. Knock that out. Just getting my calculator. 16,000 minus 12,500 is 3,500. So you have additional loss here of 3,500. When I say additional loss, remaining loss brought forward. So you've got the loss brought forward of 16,000. You've used 12,500 of it against this income. You now have 3,500 left of this loss, and you can add this on to this 65, so you can have 66,000 plus 3,500. So Xylophone can technically give up to 69,500. The question here is, how much can Zither actually claim? So that's 90,000 plus 13,000 minus 25 minus 10. So let's do that very quickly. 90,000 plus 7,000 plus 6,000 minus 25,000 minus 10,000. And that's 68,000. So here's the thing. Zither has profits of 68,000 technically. When I say claim, when I say has profits technically of 60,000, you would imagine, right, that you shouldn't be able to claim more. You should only be able to claim enough loss to bring your profits to 0. That's the aim here. You're trying to get you can't claim loss until you're negative, if that makes any sense. So they have 69,500, you need 68, all you can claim is 60,000, which is why this goes back up here to say that you can only claim the lower of the available loss of the surrendering company, which was 69,500, and the available profits, which was 68,000. right? And that's kind of the way that picture goes. Cool, that just brings us up to 15 minutes. So that's kind of the first three, and we'll carry on in the next video with the rest of the chapter.